excellent point. I want it to be crystal clear. We're going to show you some numbers here in a little bit. Every dollar amount I use is straight from their own sworn statutory annual statement under penalty of perjury.
Yeah.
So I'm using their numbers. I'm just calling attention to certain things people need to be aware of.
Yep. We're also, whether it's on this episode or a future, we're going to go through the top insurance companies on the annuity side and life insurance side, and you're going to give me like a quick overview in your reports.
Great.
When people hear this, obviously I just want to address this. Not all companies are created equal. There's some traditional mutual companies that have massive surpluses, and then there's some companies that are not that don't have very much surpluses, might be stock companies, might be private equity owned. Before we get into your backstory, can you just like share big picture, like the different type of insurance companies and just clarify for yourself,
Excellent.
not all of them are created equal.
Great point. There are two categories of life insurance companies that exist entirely for their own policyholders. There's fraternals, and they tend to be smaller. And if you're a fraternal insurance company, your members pay in premiums, but they're also owners of the company, right? There are no outside investors. Mutuals tend to be larger. Some of them are huge.
Yep.
Some of them are extremely well run. They tend to have very large surplus levels because they don't have an outside investor saying, hey, when are you going to send me some money? Because when you start paying money out, let me say it this way. With a mutual insurance company, you've got a pot. Premiums go into the pot, claims go out. And all companies have expenses to run it, administrative. But those tend to be very measured in mutual companies. So you got premiums coming in, claims going out. If you make a lot of money over several years, they take that money and give it back one way or another, either in policyholder dividends, premium rebates or refunds, because it self-balances. Same thing if you had more claims than premiums over a period, you have to go to your members and say, hey, we had higher claims than we anticipated, so we're going to go up on your premiums a bit. But when that happens, you know exactly why.
Right. And it's fair to say mutual companies, obviously, like the only way to be an owner is to be a policyholder.
Exactly.
And fraternal companies, you're a member.
Mm-hmm.
And so there seems to be right incentive. It's executives running a company and the profits, the surplus go to
the people who pay the premiums. It is always fair because you're simply handling a service for these people. Once it goes, if they demutualize, and that's something we should talk about.
Yeah, demutualization, and then there's straight up stock companies that feel like, from my point of view, that have more of a conflict of interest.
Yes, indeed. So what you have is the mutuals and the fraternals, because they exist for their policyholders, there's no incentive to inflate your financial appearance. But once you demutualize, if you become a for-profit company, investors begin right away. They want a return. And if you go back and look at Metropolitan Life, Prudential, when they demutualized, you can pull up the stock dividend history chart, and you'll see every year, it not only gets paid every year, it goes up every year. Except for that 2008 hiccup, it stayed the same. But so the trajectory of money out gets higher every year. So think about that. If you have a bad year, and all companies, even the best companies, have years where they lose, under the statutory accounting rules, the insurance commissioners are not supposed to let them pay a stockholder dividend if they're losing money or their surplus is too thin for obvious reasons, right? So if that happens and the CEO asks the CFO, we're getting close to Christmas. He says, "Are we gonna be able to pay that dividend? I'm sorry, we're 300 million short." They either browbeat the actuary to go back and come up with a lower reserve liability number, or they just do another non-arm's length, non-fair and reasonable transaction that creates fluff. I call it fake surplus. They fluff up their surplus in appearance only.